Good evening, everyone. Thank you for joining us for this evening's webinar, where we will be discussing the upcoming HDFC Nifty Metal ETF and HDFC Nifty Metal ETF Fund of Fund NFOs. So at this particular time, it's a pretty interesting juncture for the entire metals industry and the space in general, because on the one hand, you have new sources of demand coming from emerging technologies such as AI and data centers, renewable energy, electric vehicles, so on and so forth. And on the other hand, you also have a lot of rising global protectionism. Countries want to stockpile their own critical minerals, and all this is happening against a backdrop of a lot of supply chain disruption risk. So without further ado, I will hand it over to our lead sector analyst, Mr. Anupam Gupta, who will take you through the opportunities and the risks of the metal sector. Over to you, Anupam.
Yeah, thanks, Shikhar. Hope my screen is visible. So as Shikhar rightly said, the metals basically as a subset of commodities are in a very interesting period of time at this moment. Historically, what we have known is that the commodity space of metals is very deeply linked to the underlying economic cycles and the underlying economic growth which we see across the globe. So investments in infrastructure and the various capex which the private sector does, that has a very strong linkage to the demand of these metals as we go ahead. And if we see at the current moment, we have additional drivers which are playing out, which were not the case, let's say, a few years back. Apart from the infrastructure and industrial capex, we have interesting new themes which have come up, which are driving demand for the physical infrastructure. Things like AI and the linked investments in data centers, the shift towards renewable energy, which is metal heavy, as well as a shift in the overall transportation theme as we move from petroleum-led transportation to EV ecosystem. That all is driving demand. And at the same time, given the geopolitical tensions, we are basically seeing a rising protectionism as well as incentives which each government is trying to give to ensure that these strategic metals are produced in-house within the countries themselves. So these are basically themes which are playing out concurrently and which are driving demand for the metals in general. I will deep dive into each incrementally. So if you look at this slide, basically gives you a sense of where India stands versus all other large economies at various points of time. So if you look at the current time, um, USA and China, China obviously not USA, but China obviously has a very strong share of a very large share of both production and consumption of various metals, steel, aluminum, and copper. All of those three, if we see, they have a dominant share in production as well as consumption. India is much smaller, although India is the second largest after China for steel and aluminum, but it is much smaller in terms of the overall scale. So if you look at crude steel, China is close to about a billion tons of production, whereas India is only about close to about 160, 170 million tons, even though it is the second largest producer. Similarly, in aluminium, a similar theme plays out. But what is very important to see here is that the per capita consumption of India is way, way lower than what we see in the developed economies and also in China. And we are at a stage which is very similar to how China was, let's say, at the beginning of this century, around 2002, 2003 timelines, when China had started to grow significantly. They also were at very low penetration levels in terms of per capita consumption of steel, aluminum, and copper. India is at a similar stage at this point of time, and that basically gives us a very sort of healthy and long runway for the demand which can emanate for these three metals locally in India. So that is one underlying theme that you'll intensity of steel, aluminum, and copper usage in India will go up. Obviously, there are global linkages as well, but India itself can be a big driver of a demand for these three metals, and it will basically reflect into demand for the companies which are operating domestically, both in all the three segments incrementally. Um, Along with that, as I mentioned earlier, we are basically seeing increasing protectionism globally. So what we have seen already is that China has imposed export restrictions on rare earths in 2025. US, as we all know, has seen significant amount of tariff, which has happened on steel and aluminum. It is spurring demand. It is spurring the capex for these industries in US. In fact, just to give an example, for aluminum, we have seen the announcement of a first new upstream capacity in US in, let's say, around 40-45 years for the first time. So it's basically trying to spur local production of these metals to ensure strategic security incrementally. Just in case of resource, what we have seen is Indonesia, which is a large producer of nickel, has banned nickel exports, trying to control them and increase valuation in Indonesia itself. So basically, all the countries are either focusing on increased valuation or trying to secure metals and minerals locally to ensure strategic security. So that's what we have seen in terms of protectionism. And in India, we have also seen similar things. India is also trying to build up its own capacities for production of steel, aluminum, and copper. In case of steel, what we have seen is while India produces 160 million tons, 170 million tons of steel, we still import quite a bit of steel, which are right now not producing specific grades. And what government has done is basically launched a PLI scheme for producing these specialty steels locally in India. Close to about 43,000 crore of committed investment has happened under PLI 1 and 1.1 for steel. To back this up, it is also basically trying to improve the resource availability. So National Critical Mineral Mission was launched in 2025, which is basically focusing on the rare earths side of it. They are also trying to drive the structural demand for these metals locally so that companies have incentives to produce locally. It is basically being driven by the strong infrastructure capex which the government is doing, as well as the industrial capex which is expected to inch up because of the favorable schemes coming from the government. In terms of protectionism, what we have seen is that for steel specifically, we got a 3-year safeguard duty for steel, basically between 11 to 12% of safeguard duty on imports coming from imports into India, which basically gives you a significant protection against imports, as well as improves your profitability and gives you an incentive to invest more in the local capacities. For aluminum and copper, again, the government has laid down strategic roadmaps for raising the local production of ores as well as the end metal. So overall, what we are seeing is both from the demand side of it, as well as from the supply side of it, government is giving significant incentives to boost production domestically, and which will basically benefit the companies which are operating out of India. Indian companies, along with the incentives, Indian companies have significant structural advantages which they enjoy compared to global names. Firstly, if you look at steel and aluminum, we have abundant raw materials. So India is a significant has significant resources in iron ore as well as in bauxite, both of which are the key raw materials for iron and aluminum production. So that basically gives you an advantage because you have locally available raw material, which you're saving on logistics, and it is cheaper compared to global sourcing of these raw materials. Secondly, if we see from the names which are listed in India, most of these companies are integrated in terms of the operations. And how that benefits is that you have full control over your raw materials. So iron ore, so steel companies own, steel companies, for example, SAIL and Tata Steel have captive iron ore, although that is changing incrementally, but at least you have some security there. The aluminum producers have captive bauxite and incrementally low cost coal as well, which are the two main raw materials for aluminum. So so the integrated model makes you a lower cost producer versus global names, and gives you a significant protection in a way. Even if global prices fall, it will be such that you will be able to produce steel or aluminum for a long period of time, even if the prices are low. So the cost position is significant advantage for these companies. And thirdly, if we see, we have a long runway for growth. What I mean there is, as we talked about a couple of slides back, the domestic strong demand itself is an incentive for these companies to produce locally and be at an advantageous position versus global names. So a long runway of growth domestically, and you are sitting at a globally significant cost advantage versus the global steel or aluminum producers. So all of those factors are the key structural advantages which domestic listed companies have and will continue to benefit from. Additional factor would be the gains which we can see in the user industries as China plus one plays out. So as demand of production of various end user industry shifts to India because of the China plus one requirement in the global supply chains, it will drive demand for metals locally in India. So those are the 4 5 factors which will drive demand for these metals, as well as incentivize these companies to continue to invest. What we have seen over the last 4 5 years in metals is that, obviously, given that these metals are global commodities, there is significant volatility in prices as well as profitability, which you can see in the right hand chart. But what has happened over the last 4 5 years, which you see in the left hand chart, is that the leverage has come down. What has helped that is, even though there is volatility, the profit levels and the scale is such that you are generating enough operational cash flow, which is able to service your CapEx requirements as well as lower your debt, and which is what is reflecting in the left-hand chart, that the leverage levels for most of the steel names has come down over the last 4 5 years. Even for aluminum names, the domestic leverage is, in fact, Hindalco is a net cash company at this point of time. So we have seen leverage being favorable for these companies, which is a factor of healthy profitability, even though there is volatility, and the increased scale at which these companies operate at compared to a decade back. And incrementally, that scale benefit will continue to increase only. So as the scale goes up, your operational cash flows these companies will generate will ensure that all your capex requirements are majorly funded from internal cash flows. So the leverage will continue to be a low for these, and which is a significant advantage in a very cyclical industry when you're operating in. Globally, if you look at metals, also provide a hedge against inflation. So generally, what we have seen historically is that metal prices reflect how inflation is playing out. In a high inflation environment, the commodity prices also inch up, and vice versa. So in a way, this is also a hedge against inflation. And metal, we have a significant history to indicate that, which is also beneficial in the current trying times in terms of geopolitical tensions which are playing out. So this is the key background on which we are basically launching this NFO. I'll hand it over to Shikhar to talk about the index and how the fund is placed. Yeah, Shikhar, over to you.
Yes, thank you, Anupam. Can we move? Yes. So, as Anupam said, I will just give a brief explanation of what the Nifty Metal Index is. What is the methodology, what kind of stocks are actually in the index, and how it's providing you very broad and diversified exposure to the entire metals industry in India. So, at a methodology level, it's an extremely simple sector index. It's just in simple terms, choosing the top 10 or the top 15, so the top 15 largest companies from the metals and mining sector out of the Nifty 500. So in effect, you have an index which just has the 15 largest companies across a variety of sub industries, but all from the metals and mining sector. And every year, about twice, so in March and September, the portfolio is reviewed to see if any stock needs to be added or removed. Generally, there are not too many metal stocks which are getting listed, so the turnover is quite low. And by and large, the names that you see on this slide on the right are more or less, constant in the index. So many of these names need very little introduction. So you have Tata Steel, Hindalco, JSW, Adani Enterprises, which is a bit of a conglomerate. So again, a lot of exposure to essentially iron and steel, aluminium, then some finished products also, finished steel products, which you can see via APL Apollo tubes. And there are also, we'll see on the next slide, there are a few, specialty zinc and copper plays as well. So this is basically, when you buy the index or when you buy the ETF or the FOF, these are the kind of companies you are getting exposure to. In terms of the split between large, mid, and small, again, fairly diversified. 75% of the index consists of large cap names. around 20% is in mid caps, and the remaining 4.5% is in small caps. So that's the sort of split across market cap segments. Lastly, I'll just mention in passing about the valuations of the index, because this is a very common query, before investing. So if you look at the PE and the PB, those are both lower than the Nifty 500 index, and correspondingly, you have a higher dividend yield for the metal index versus the 500 index. So optically, it is sort of cheaper than the broader market. But I think one point that's worth highlighting here is that as Anupam mentioned, the industry tends to be quite cyclical, and also has generally lower return ratios than the broader market. So that's why its valuation tends to be lower than the broader market, right? But just in terms of where we stand today, those are the numbers: about 16.7 PE versus 22 PE for the broader Nifty 500. So yeah, that's basically what the index looks like in terms of the constituents split between large, mid, small, and also the valuations. And as I mentioned, it's diversified not only across market caps but also across the basic industries: iron and steel, aluminium, steel products. These are some of the largest basic industries within this index. So now coming to the historical returns, we can see that this index over the last 1, 3, 5, 7, and 10 years, it has outperformed the broader Nifty 500 TRI. Right. So if you just look at the chart on the right, you'll see the dark blue line is the Nifty Metal TRI. So it's had a particularly good period, post COVID. There was almost a decade where the index kind of went sideways. It was extremely cyclical at that point. As Anupam showed you, even the companies tended to have more leverage. So all that led to a higher amount of cyclicality and volatility in the index. But since 2020, the supply side disruptions to some extent, the better balance sheets of the companies themselves, they have led to a slightly more it's still volatile, but at least the trend has been much more pronounced in one direction since 2020. So that's why, over the last several horizons, you are seeing an outperformance. But if we go very far back to 15 years or so, then the index is performing broadly in line with the broader Nifty 500 TRI. I think more interesting than just these point-to-point returns, the next two slides, one of which is the returns by financial year, and then we'll come to rolling returns. Let's focus on the financial year returns, right? So the main two takeaways. One is that of all the 22 financial years for which we have data, going back to 2005, it's a pretty evenly matched performance between the metal index and the 500. So in around 11 of those years, the metal index has done better than the Nifty 500, and vice versa, right? So the second thing that is very interesting to note is how the metals index tends to fall more during periods of economic slowdown or financial crises or so on and so forth. But very importantly, also then tends to rally a lot more during the recovery. So if we look at FY 9 and 10, we see that the metal index fell more than the broader market. But once the recovery happened, when the global economy, came back sort of after the crisis, you can see that in FY 10, for example, the metal index gave you 187% return compared to 90% for the broader market. Even during COVID, when COVID happened during that period, because the global economy effectively shut down, you had all these industrial commodities which are very sensitive to the business cycle fall sharply. So the stock prices also fell sharply. But look at the rebound since then in FY21. And now, unlike the previous decade, we have seen many more years where the metal index is doing better than the 500. And that's because of A, the new demand drivers, and B, the sort of protectionism and the supply chain disruption risks that we have been facing for one reason or the other. So I think this FY table, actually has a lot of interesting takeaways. And we can move on to the next slide, which is the rolling returns. So, in terms of rolling returns on a 1 year and 3 year basis, on average, the metal index has given you better returns than the broader market. That pattern is not so clear cut, on in the 5 and 10 year period. But at least in the 5 year period, on average, it has still given you similar returns, slightly lower, but similar returns to the broader market. So while the return profile can be sort of quite interesting, from these 1 and 3 year perspectives on a rolling basis, I'd like to just highlight that these returns have come with a high standard deviation as well. So in some cases, the standard deviation is almost double or even more than that compared to the broader index. So this is to be expected for several reasons. One is that this is a sector index, so sector indices generally tend to have a lot more volatility than the broader market by definition, because there is no benefit of multiple sector diversification. You are specifically choosing this sector because you believe it can give the high return. Hence, you get the higher volatility. And secondly, metals themselves, even though there are a lot of structural positives at the moment, it is still a cyclical industry, subject to the ups and downs. So you get a higher standard deviation as a result, right? So the main takeaway from this slide is that because it's a sector fund, in a sort of volatile sector, investors should only allocate. They should take controlled exposure to these kind of schemes. When we usually talk about portfolios as a core and satellite, core is your part of the portfolio where you have mostly diversified equity mutual funds, basically diversified being the key word, whereas satellite is the smaller portion where you tend to take riskier funds which have higher return potential. So both the ETF and the FOF, they would ideally fall into the satellite portion, where you have a smaller allocation, but you are taking that allocation with the view of getting above market returns. So with that, we'll just move to the specifics of the product itself. There are two NFOs. In this presentation, we've just showed one, but the metal ETF, the NFO dates are July 20 to July 24th. So that's Monday to Friday. And for the FOF, it's a longer period. It's from July 20 to August 3rd. So that's almost a full 2 week period. In terms of why should one invest in the ETF and the FOF, just very quickly to recap, there is a lot of still long term growth potential, thanks to not only the continued capex spend, but also new sources of demand which are coming up through AI data centers, EVs, renewable energy, so on and so forth. And as Anupam showed us pretty much on the third slide of this presentation, that our per capita consumption is still very low compared to global peers. China may be an outlier because they had an exceptionally large construction boom, manufacturing boom, so on and so forth. But even if you looked at the US, right, they are around 280 kgs in terms of steel per capita. We are still 86. So there's a lot of room when we look at those kind of countries in terms of catching up, as we ourselves move towards that the aim of a developed nation status. Second is that there are a number of policy pushes by the government to, it sort of fits into the broader Atmanirbharta theme, that India has wants to be self-reliant in these metals. We've seen, what having a very large import bill, what that can lead to in terms of pressures on the current account deficit and the rupee. So the government has very much made it a strategic priority to, be self-sufficient, aim to be self-sufficient in these metals. And that means, in turn, more production, more investment. So the beneficiaries should be our local companies. And lastly, it's not just about getting a government push. Many of these companies, because of their integrated operations, because they source their raw materials cheaply, they are at the lower end of the cost curve. So even if you wanted exposure to metals, to metal companies, Indian companies are some of the best ways to get that because of their competitive cost structure in our in the global environment, right? So before we conclude, just want to take you through the key risks and how these are can be potentially mitigated. So one thing we've mentioned repeatedly is that demand and pricing are highly cyclical. So there are these ups and downs in the cycles, but what is different now compared to the past is that the companies have, on average, much stronger balance sheets. So even if prices go down, they are not sort of selling at a loss. They are just, in most cases, making less profit, right? So they are able to withstand these downward these downturns in the cycle, and they don't have to be forced sellers of assets or anything like that. They are able to manage the down cycle and then enjoy the sort of booms as well, which come every now and then. Second is that because of its critical nature with respect to um, national security, and it's so important for every economy, it's obviously subject to policy risks. So there can be changes in mining regulations, tariffs, as we've seen with the US, for example, environmental laws. All these things can happen, and they're difficult to predict in advance. But many of these companies, they are also exporting, or they have a very globally diversified client base. So both their operations and their end markets which they sell into, tend to be globally diversified. So this partially mitigates the policy risk. And second thing we should keep in mind, many sometimes policy changes can actually be positive for the company. So we saw in April 25, the government implemented a safeguard duty on steel imports, effectively making them 12% more expensive. So that was a positive for our own local steel companies. So this risk sometimes can actually be a benefit for companies as well. Third point, I discussed this in the rolling return slide. The metal index tends to be more volatile and have higher drawdowns than other broad market indices. So the way to mitigate this risk is to sort of do a staggered investment via SIP, STP, so that you build up your position over time, right? And last risk is that because it's sectoral, there's a little bit, there's more sort of concentration risk, because if the industry doesn't do well, then the entire all the companies or several of the companies may sort of go through that lean patch. But the way to sort of mitigate this risk is to take controlled exposure to such funds. So when I said that in the core satellite framework, this comes in the satellite framework, where you are giving it a smaller allocation, but with the expectation or the hope of getting higher returns. So just in terms of why invest in our ETF and FOF, just want to highlight our strengths as HDFC, AMC, and passives. We've been one of the oldest players in the passive industries. We have several funds which in fact have a track record of more than 20 years. We have a very wide product range, so almost 50 schemes, and this is going to add, from 19 ETFs we'll go to 20, and from 3 FOFs we'll go to 4 with these upcoming schemes. And most importantly, while we have been around for a long time and we have a wide product range, we also are amongst the largest funds across several categories. So those categories include market cap based index funds, commodity ETFs, and even small cap ETFs, right? So these are all places where we have some of the largest funds, and are able to sort of demonstrate our experience in the space. In terms of the scheme itself, quickly I'll just take you through the FOF. It's going to be investing in units of the HDFC Metal ETF, a Nifty Metal ETF. In terms of the very indicative expense ratios, the ETF is expected to have an expense ratio of around 30 bips. That's the base expense ratio. So GST and other charges would be extra. And for the FOF, the regular plan is expected to be, sort of around 60 bips of base expense ratio. Again, the statutory levies, including GST, so on and so forth, are extra. So that's very roughly, what kind of TER expense ratio we would be looking at for these two products. And in terms of the allocation, so here in the FOF, the scheme is going to be buying units of the metal ETF. So around very close to 100% will be invested in the ETF units itself, whereas the ETF will be the instrument which holds the underlying stocks. So the 15 stocks that I mentioned that are in the index, the ETF will be holding them in the index. Will be holding those 15 stocks in their index weights, as per their index weights, and the FOF in turn will invest in units of the ETF. So where does the FOF come into the picture? Usually it's for investors. It's a big help for investors who do not have a demat account but still want to participate. They can do so with the FOF, through the FOF route. And just to conclude, this is the riskometer for the FOF. And finally, the disclaimer. So with that, I think we can move on to Q&A. So let me just take a look at what are the questions we have. So we have one question. Can you please elaborate on the cyclicality of metals and metal companies?
Yeah. So basically, the reason why metal commodity in general and the companies along with that are very cyclical is um, commodities are very. So basically, the why it is called commodity firstly is that you can't differentiate. So hot rolled coil of steel made in India is the same as hot rolled coil of steel made in Vietnam or China or Europe, right? So the supply demand basically is global, and you are exposed to global investments in new supply, global disruptions to supply, global disruptions to demand. It's not just India specific demand or supply which impacts it. So that is one reason why it is very cyclical and open to global impacts. And secondly, if you look at these industries, these are very capex heavy. So what I mean there is that you need to do a lot of capital investment to generate $1 of revenue. And basically, what that means is that because of the high capital intensity, your impact on profitability is very high in case of a small movements in prices of the steel or prices of the aluminum itself. So those are the two factors which make it very, very cyclical. And the stocks also react in the same way. So because aluminum, if you just look at aluminum or steel prices in the last 1 year itself, aluminum has gone from $2,700 to a peak of $1,300, and now it is down to $3,100 per ton. It's basically reflecting the sentiments or the expectation on demand and supply globally for aluminum. So that's where the cyclicality emanates from, and these stocks are also similarly reacting to that cyclicality in their own form. That said, the cyclicality, although I'll not say that it goes away, but basically once your scale is much larger, which is the case at this point of time, you can withstand those cyclicalities much better. So your impact on the bottom line is lower if your scale is much larger, and you can absorb that cyclicality in the earnings much better as your scale grows, and which is the case for these companies listed in India at this point of time.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.